but it takes time always to build. So the fundamentals that we saw back in the recovery years, 2009, 10, 11, really have now had time to play out. And what's exciting about Europe today, pretty much every metric you could think of looking at is up. And it's up for consistently year on year. So I put a few examples here just on the volume of activity. In the upper left corner, you see that year on year, more deals have been done and more capital has been expended. We don't yet know how 2020 will play out. It's been a great year in some ways. It's been a terrible year in other ways. So far, we look on track to meet or exceed 2019, I would say, but it's a very dynamic market. But what's exciting, and I think a great opportunity for investors, is not only the volume of activity has grown year on year, but the quality of the activity. And you really need both of those things to generate big outcomes. In the right on the top, you see a proxy for big outcomes, shall we say. This is not the answer, but this is the number of private companies, venture-backed companies, which exceed $1 billion in valuation each year. And this kind of unicorn index, it's a shorthand. As I say, it's to be viewed with some skepticism, but it's a shorthand for big outcome generation. And there too, we have a great story, year on year, terrific growth. And as we'll learn in the secondary discussion in a moment, this growing stock of assets is the fundamental base for the whole secondary market, and therefore the exciting opportunity, a second order opportunity in secondaries. But I get often the question, okay, but if I'm an LP investing in funds, what does that look like for me? So on the bottom two charts of this slide, we put two things. One on the left side, just the long-term venture capital point of view. What sort of return could I get in venture if I invest consistently over time? It's a wonderful asset class. You must be patient. You must tolerate illiquidity and risk. But for those who do, there pretty much isn't a higher performing equity class. And that's looking over long periods of time. Looking over shorter periods of time in the lower right, we've put here the Cambridge Associates benchmarks, comparing the European benchmark to the US benchmark. And this is a surprising chart to many people. Europe has been consistently outperforming the US on an index level. Now, it's dangerous to talk about venture capital on the average because in this area, averages are less predictive and less explanatory than any other type of asset class. In other words, the dispersion of returns is very wide. However, if one simply threw a normal distribution of darts at the venture capital market, Europe's done very well over the 3, 5, 10-year periods. So that's also the nice evidence that a lot of LPs look for before entering the asset class. And my final slide, if I could move to the next one, just to make, we're going to hear from some learned experts in a moment, so I won't talk about secondaries. They're part of what we do. We approach secondaries in an opportunistic way within our existing portfolio. However, I wanted to make a kind of high-level comment about the growth in the venture capital secondary opportunity. And a simple way to think about private secondaries is there is a stock of private assets available, and there is some percentage of them which trades each year. And if you multiply those together, you get the total volume each year. And in private equity, as a large category, that's been growing year on year for a couple of decades now, and so too in venture capital. And what we see is really on both of those metrics, the total stock of assets is growing over time. And that's really for two reasons. Firstly, there is more capital being invested. Success begets more capital, begets more success. So the actual volume has gone up, as I described. But an equally powerful feature is that the holding periods of these companies are growing. and they're staying private longer. Therefore, the stock is growing, and that's leading to buyers with an ability and an insight being able to pick up attractive assets. And so we see this trend growing for years now, and no sign of stopping. So I'll leave it there just with a little teaser of how excited we are about this opportunity going forward.
Thank you, Joe. That was very comprehensive. Let's move on to Dave McClure, who will speak about Silicon Valley VC secondary strategies. Hey, Dave, good to see you. Brief intro, Dave is the co-founder and managing partner of Practical Venture Capital. He has been an entrepreneur and investor in Silicon Valley for over 25 years and was also the founder and managing partner of the 500 Startups. Previously, he worked at Founders Fund and PayPal and graduated from the Johns Hopkins University. Dave, floor is yours.
Thanks, Marcus. I guess good morning to folks in the US, and to folks in Europe, and good evening to folks in Asia. So we have a number of folks from around the world. As Marcus mentioned, I've been an investor and entrepreneur here in Silicon Valley for about 25, 30 years. Thanks also to Joe for the initial comments and intros. Actually, just to clarify, Joe is also quite an expert in the field and has more than just some exposure to the secondary market. So his remarks, I think, are quite insightful. I guess just to pick up on a few comments that he made, there's been a significant growth overall in exposure to alternative assets. That's pretty much true for many investors, even at the retail level. Part of that has been driven by venture capital, and there's been an increased interest in many different types of investors in getting exposure to venture capital. We've seen growth around the world, definitely in the US, but also in many other markets, including Europe. And with that, we've definitely seen more companies staying private longer. And I believe that's largely due to the fact that there's so much more capital available for private companies. Again, that's being driven because there has been demonstrated success and growth by these companies. As a result of that, many different types of investors want more exposure to private companies. They're not able to get that growth if they just remain in public markets. So we've seen a number of different types of investors, both early stage venture capital increasing their exposure by becoming larger. We've seen increases by other public market investors wanting to get into venture capital. And we've seen, actors from just international stages and many other places. Marcus, I think if you could move forward to the first slide. This slide really talks about how a venture capital fund deploys capital over time. In this case, we're looking at an early stage venture capital fund starting from seed stage. Typically, most VC funds are set up to be 10-year illiquid vehicles. However, these days, I would say it's much more common to see these funds go at least 12 years, if not 15 years, and in some cases, it can go even longer. The companies that do well in these funds that go to an IPO will typically take about 9 to 10 years to go public, and sometimes maybe even longer. So, one of the challenges about investing in private companies and also in venture capital funds is that it's hard to know how things are going to turn out, and you have to wait quite a bit of time to see how well things are going. I think Joe mentioned, definitely over time, venture capital has shown to perform pretty consistently better than other asset classes, but that's probably only true in the average case, and that average is heavily weighted by a small number of extremely well-performing funds. So as a venture capital investor, it's true that the average return is fairly substantial, but that's usually dominated by a small percentage of firms that are in the top quartile is what we typically talk about. Regardless of whether they perform well or not, you usually have to wait a while to see how well things are doing. So what if there was a way that you could cut that down, basically cut a VC fund in half and buy the funds and companies that are winning? So that's really the strategy that we're talking about. with venture capital secondary, and specifically we're talking about fund secondary, so buying LP and GP interests, not just companies. If you look at a VC fund over time, particularly the first 5 years, at that time it's fairly high risk. The companies they're investing in may be small and still developing. Many of those may fail. If you think about a normal fund that might have 30 companies starting at seed stage, perhaps a third of those might get to a Series A event, maybe half of those get to a Series B or C event. Typically, we would see probably only the top 10 to 20% of these portfolios getting to some level of success. But after about 5 or 6 years, you can start to tell whether these funds are working or not. So it would be great if you could sort of jump in at that point, skip that initial J curve period where there's a lot of risk and not a lot of liquidity, and kind of get to the point where the companies are already growing, the fund is obviously doing well, and that would be great. And people might question, why is that going to be the case? Why would people be selling their positions in these winning funds? Again, we noted before that there's a fairly long time frame for a lot of these funds to get to some liquidity. And for many smaller LPs and investors, they may not have a long-term time frame for investing. Some of them may have other financial liquidity needs along the way. So if we can think about kind of skipping that initial 5-year period, we also get the opportunity to buy at a fairly substantial discount, particularly in market distress scenarios or uncertain scenarios. But as a result of that, we can really cut the holding period in half. Marcus, if you could skip to the next slide. So rather than having a typical 10 to 15-year holding period for venture capital, in this case, we think the holding period is more like 5 to 7 years. And probably even more importantly, the initial return of principal, we think, happens within just a few years. So if you can think about buying at maybe an average 7 or 8-year-old fund kind of time frame, that's just about when funds are starting to have initial liquidity and initial distributions. We're buying right at that period of time. So within about 3 years, we expect to see hopefully a 1x or better return of principal and an overall performance that might generate 2, 3, 4x or better within a 7-year time frame. So we kind of cut the VC fund period in half. We get in at a discount, fairly substantial discount, and we're cutting the holding period and also getting faster return of principal and faster liquidity. If you can skip to the next slide, Marcus. Again, you might wonder, what's the catch? Why is this the case? And if it's really such a great story, why aren't more people doing it? Well, in private equity secondary, they have been doing it. The private equity secondary market has been around for now about 20 years. We've seen a substantial growth in that market. Now, last year, I believe, close to $90 billion of private equity secondary. In venture capital, we've seen the company secondary market also grow quite substantially, particularly in the last 5 years. But if you look at venture capital in the fund area, there's been a number of these smaller funds that have been launched over the last 10 years. In the US, maybe starting as early as around 2005. In Europe, more around the 2010 period. And these smaller funds are comprised of LPs that are not necessarily institutional in size or patience. So there may be a lot more individual participation, family office, and occasionally corporates. And for many of these investors, they may not have as patient a holding period. They may have needs in sooner than 10 to 15-year timeframes. So as a result of changes in their liquidity needs, either family or structural changes in their organizations or in the market, they may want to make purchases in other asset classes, and they may need to generate cash. In a recent transaction back in Q2, when coronavirus was really on the radar for a lot of people with a lot of uncertainty in March and April timeframes, there were a lot of people who were looking for cash, and we were able to conduct a transaction at about a 40% discount to value. Looking forward over the next 6 to 12 months, we are also seeing certain sectors in the market that are definitely uncertain, and my partner Aman will talk about those in just a few minutes. But for folks that have more exposure maybe to the transportation or hospitality industry or in certain real estate asset classes, they may have very real needs to generate cash for those markets. On the general partner side, particularly for smaller funds and for firms and partners that maybe haven't reached an institutional level of scale, they may also see value in selling a portion of their fund or individual companies in order to realize some gains as they're raising new funds, or to generate cash for either recycling or distributions, or possibly for their own operational expenses. So there are quite a number of reasons why people might sell that are not just based on distress. In particular, they're not usually based on the company's level of distress. They're really more financial needs and liquidity needs on their side. I'll stop with, well, I'll talk a little bit more just to clarify between fund secondary and company secondary. Many people use the term secondary quite broadly. Very simply, company secondary, you're buying an equity stake in a single company. There's quite a number of different avenues to do this these days, including retail platforms. On the fund secondary side, however, it's not very easy to know what type of assets are available and whether they are for sale. You're buying a slice of LP interests across buyers. There are a few firms that are doing this. You know, in general, there's more sellers than there are buyers, and as a result of that, there's a fairly substantial discount and arbitrage opportunity for buyers. Marcus, maybe if you could skip forward just one more slide. So as a buyer of these assets, maybe, sorry, just the previous slide there. As a buyer of these assets, we're trying to evaluate, you know, what's available. That may not be visible to many folks who don't have experience in the venture capital market. You're trying to assess a basket of assets, not just one asset. So that might be a little bit harder to value, especially for folks who haven't been early stage investors before. And then there's also the timing of these exits. So for the larger companies that maybe already at $1 billion or more unicorns, those may be easier to evaluate, and an IPO may be on the horizon within the next couple of years. But for the smaller companies that will be large to IPO yet, there may be some probability about whether they're going to get to an exit and when. And for many folks, that may, you know, discount the value of those assets, or at least make it harder to evaluate when liquidity is likely to happen. So again, fund secondary is a tremendous opportunity, but it has to be done by someone who knows the value of those assets. That's generally a buyer's market, but only for buyers who know what they're doing. Marcus, if you can skip to the next slide, we'll just show this briefly, and I'll let my partner take over here for the next section of the talk. You know, we do see that there's been significant growth in the private equity secondary market over the last 20 years. We think that that growth is also happening in venture capital secondary, and it's on a similar trajectory. These markets have been punctuated by downturns. Usually that's been a good period for secondary market growth. Usually in these downturn environments, there are more sellers available. But again, the VC fund secondary is still a growing part of that isn't accessible to most folks. And we think that's a great opportunity for investors. Thanks, and I'll pass it along to my partner now for the next section.
Hey, excellent, Dave. Thanks a lot for this overview. I think there was a lot of information shared, so I would like to encourage all the participants to start asking questions, so we have a lively discussion afterwards. After Dave, we will now hear Aman Verjee speaking on 2020 tech IPOs in SaaS, e-commerce, and payments. And as a brief intro, Aman is one of the founders, partner of Dave, general partners of Practical Venture Capital. Before that, he was chief operating officer of 500 Startup, when they were the world's most active venture capital firm. And he also has been the CFO of Sonos and of Collective, an advertising technology company in New York, which operated a 50 million SaaS business. I think with this, Aman, I'm looking forward to hearing your thoughts.
Great. Thank you very much. Good morning and good afternoon and good evening to everyone. I see we have people dialed in from about 7 different time zones. So whatever part of the day you're in, I hope you're enjoying it. If you can move ahead one slide, Randy, I want to talk to you a bit about a very hot sector in technology, one of the hottest sectors. It has been one of the hottest sectors over the past 15 years, and it's a prime beneficiary from the economic dislocation that began back in March when COVID-19 became a pandemic, and that's the SaaS sector. So I want to give you a current state of that industry, how we think it's performing and unfolding. A lot of our investments happen to be in that space, and as you can tell from our introductions, both Dave and I have spent a lot of time around that sector and fintech and e-commerce. So I want to share some thoughts on that today. So you might have heard, and you may know that SaaS tends to be perceived by investors now as very expensive. It's had a very long and very good run, trading at very rich multiples. We've put together a proprietary index at PVC. It's called the PVC SaaS Index, and includes all the US publicly traded SaaS companies. There are about 100 of them altogether. And at the end of 2019, this index was trading at about 9 times revenues. And that's up about from 5 or 6, where it's typically been over the past 11 to 12 years in this US bull market. The bull market began around March 2009, and the valuations are at all-time highs. At the end of 2019, they were over 9 times. In March, when the market was spinning down, it bottomed out at about 7 times, but as of last quarter, it's up at a all-time high now of 11 times. So any way you look at it, it does seem like it's expensive. At the end of last year, when it was hitting its all-time high, you might have thought, these are .com valuations. This doesn't make any sense. I don't want to invest in these tech companies, and I just want to put my money into a safe index fund that just tracks how my geography, how my country's doing. And in particular, if you'd known there was a global pandemic coming, you might have been forgiven if you just walked away from the sector, waiting for the market to correct and invested in your country. So let's just think about how your investment would have done. If in January 1, if you'd gone and just invested in a basket of stocks generally. I see some of you are dialing in from Germany. The German DAX is down 3% year to date. In France, it's down 18% year to date. In the UK, it's down 20% year to date. Spain, the IBEX is down about 25% year to date. In Japan, you'd be about flat. In Canada, you're down 7%. In the US, the S&P 500 is up a little bit, 3% year to date. The tech-heavy NASDAQ in the US is now up 18% year to date. Hold on a second, let me just check how the market's doing today. It's been a very volatile couple of days. All right, it's up about 2% today. So I'm having to change my remarks over the past 24 hours based on the volatility in the market. The strategy's the same, but the numbers are a bit different. But you get the idea. So the NASDAQ has definitely outperformed. The tech part of the market has outperformed significantly. You would have lost about 10 years of returns if you just simply walked away from tech. What's even more interesting is that SaaS, the SaaS PVC SaaS index, is up about 50% year to date. So if you'd walked away at the end of 2019, you would have made probably a mistake that you're kicking yourself for. Why is this sector trading at such a rich multiple? And this isn't a 3-month thing or 6-month thing. Over the past 5 years, this sector has returned 40% annualized returns. This is a public market index giving you venture-like returns with the liquidity, with the transparency of public company governance. Why is it and how is it that this sector continues to be such a darling of the markets? To go ahead one slide, Randy. Let me tell you about something called the SaaS Rule of 40. This is something that venture investors came up with probably about 5 years ago. I don't really know who invented this rule of thumb. I know that Brad Feld, who is the founder of Techstars, was blogging about it around 2015. But I think this has been around for a lot longer. If you Google it, it's all over the place. But here's the basic idea. The SaaS Rule of 40 just says, the sum of your growth rate and your operating margin should equal to 40%. So in a simple example, if you're growing at 20% a year, you should be generating a profit at 20%. If you're growing at 40% a year, you could be generating a profit of 0, meaning you're basically taking all your gross profits and investing them in the growth of the business. And these are good businesses, they're investable businesses. These venture firms have been following the SaaS Rule of 40 for years. The top VCs in the world have been scouring the earth looking for software companies that fit this rule and investing at 10 to 20 times revenue multiples and generating top quartile returns. So it's a good rule of thumb just to assess a venture investment. Now let me take this entire public market index and superimpose this on this chart, which kind of measures where the rule of 40 is. Go ahead, Randy, one more page. So on the y-axis is the growth rate. On the x-axis is the free cash flow margin, kind of a close proxy for operating margin. Anywhere on that green line, you're meeting the rule of 40. And as you can see, the entire index, the entire PVC SaaS index, these are just the 2017 IPOs and beyond. These are the more recent IPOs. 35 companies, 400 billion in market cap. As an industry, they are trading better than the SaaS rule of 40. The average growth rate at the end of Q2 here was 44%. The average profit margin or free cash flow margin was 10%. So most of these companies and the industry as an aggregate is trading and performing like a SaaS unicorn. So yeah, the valuations are rich. There's no doubt about that. But I would argue, at least as of Q2, the industry is performing the way you'd expect, given the valuations, and valuations are just following the performance of the sector. There's something else going on as well. Let me fast forward one more page, Randy. Let's talk about e-commerce for a second. So this is the e-commerce market in the US, and the line represents the market share of e-commerce, the percent of retail sales that's in e-commerce. For years, it was in the low teens, mid-teens, slowly creeping up 1% a year, 2% a year. And all of a sudden, in 2020, the penetration rate has jumped into the mid-20s. Within 1 quarter, e-commerce has accelerated by about 3 to 5 years. As an example of this, I was listening on Nike's earnings call. My old boss, John Donahoe, is the CEO there. And as John was going through the results of Nike, he basically said 30% of their sales in Q2 were online or direct. And that was their 2023 goal. So for Nike, their futures accelerated by 3 years. And they're not going back to their 2019 goals anytime soon. In fact, what John did is he set out a new goal for the company at 50% direct or online. So they've just taken the future and accelerated it permanently by about 3 years. There have been a lot of winners in e-commerce over the past 6 months. There's been over $1 trillion in market cap that's been created in the e-commerce sector. And most of it has gone to those 9 brands on the top right of the page. But on the flip side, there have been a lot of losers. There have been a record number of retail bankruptcies in the US. Many of them are household names, and that's the bottom right. So companies that got this digitization trend figured out succeeded. Those that didn't. And all of a sudden, digital has gone from being nice to have to existential, meaning every single company has recognized, holy crap, if I don't get this right, we're dead. So it's not this is not a temporary shift. This is a permanent shift. And yet, even with this realization, e-commerce is only 1/3 of retail sales in the US and far less abroad. So the market is still very underpenetrated. If you go ahead one page, Randy, I'd argue the same thing's happening in SaaS. That graph on the left shows cloud-based spend, SaaS, infrastructure as a service, platform as a service, PaaS, IaaS, SaaS, all the asses basically are in the green. And that cloud-based spend only makes up 25% of IT spend. For years, these SaaS players have been taking share from the traditional ASPs and software incumbents. And even with the COVID acceleration and adoption I talked about of remote software and SaaS solutions, the market here is still very underpenetrated, only a quarter as at the end of last year. And I think SaaS will keep taking share rapidly over the next few years, really for the following reasons. SaaS is going through the 3rd generation now of its quest to deliver a better product and a better customer experience to on-premises software. The 1st generation was large enterprise players like Salesforce and Oracle. They really targeted Fortune 200 companies in the late 90s and 2000s. And they specialized in these company-wide deployments, and they cost tens of thousands of dollars to deploy. They sold on a license or per-seat revenue model. They definitely figured out a better delivery model because we went from customer-hosted to vendor-hosted software, and that was great. Overnight, customers didn't have to deal with overhead and the labor cost that it just takes to maintain your software. And they also had a better economic model. They replaced the overhead expense and internal IT costs with a predictable monthly subscription fee. So all that was positive. But Salesforce and Oracle were very hard to adopt. I was running a finance team at PayPal in 2010, and we were just afraid of a company-wide deployment of Oracle. We knew it made sense, but it was just high risk of failure, very expensive, a lot of company-wide buy-in, and that just made it prohibitively difficult to adopt. Well, Gen 2 comes along, like Zoom and Zendesk and Asana and Slack, and all of a sudden, the adoption gets a lot easier. And a lot of those companies started selling subscriptions on a monthly basis at consumer prices. So they made the adoption a lot easier and cheaper. These new companies are very much focused on user experience, and they began selling at price points that now everyone can afford. And so they multiplied the TAM for SaaS from large enterprises to all enterprises. And these companies are on a whole different growth path than Gen 1. Well, now we're seeing Gen 3. This is another wave of SaaS companies like Stripe and Twilio that have made APIs a part of their competitive advantage. They live in an ecosystem of other software providers, and they interact with these software providers all the time via these APIs. And what that enables is that they can now focus on very specialized use cases. And I think that that is also exploding the TAM for SaaS in unexpected ways, just like Gen 2 did. Take a company like Anaplan. They offer a solution just for FP&A, for financial planning and analysis. A very, very specific use case. 10 years ago, if you'd have told me there could be a viable business, a company that could just focus on FP&A, I would have said, no way. I mean, I run an FP&A team. I have to use whatever my finance team uses. I have to use Oracle or SAP. I can't be a cowboy doing my own thing. Well, Anaplan now enables any FP&A team to do cloud-based financial planning. And that means that they can interact with all the other systems that finance needs. So, and they're not alone. That's just one use case. That's Anaplan and FP&A. Zuora does subscription billing. Zuora is a multi-billion-dollar company. Anaplan's worth $7 billion on the market today. There are a number of these SaaS unicorns chasing HR solutions like Zenefits or Paycor or Gusto. They're selling to payroll specialists, to performance review executives in HR. And so all these functions inside of a corporation are now SaaSable. They can be very deep and very large markets, although they seem very narrow in their function. And you can build a low-cost SaaS product that makes it just better and easier for any of these functions to operate in a remote workforce. So could the ceiling on spend here, I mean, the spend is not going to go from 25% to 100% of IT spend. Could it go to 50%? Could it go to 60% in time in the next 3 to 5 years? I think it can. All right, I think that's about it. I'll just give you one more brief note on another driver of market expansion, just for context. And this is just the U.S. There's two charts here on the left and right. There's a monetary stimulus chart on the left that just shows you the size of the Fed balance sheet and the amount of money they're putting to work in monetary stimulus. And that just shows you that the balance sheet of the Fed has gone overnight from around 4 trillion to 7 trillion. It is an unprecedented level of monetary stimulus that's driving a lot of the market gains in the US and abroad. And on the right side, these are the US fiscal deficits. The further down the chart goes, the bigger the deficit. And you can see over time, the deficits that have been happening in the US have gotten bigger and bigger. Each of those red arrows is a recession. With each recession, these deficits have gotten bigger and bigger. The one that we're now going through in 2020 is the largest, by far the largest fiscal stimulus the US has ever done as a percentage of GDP. So, great sector, great industry, tech generally performing well. Add to that just the backdrop of unprecedented monetary and fiscal stimulus, and I think that's a lot of what's going on in the market. Okay, I think with that, I'll wrap up and turn it back to you, Marcus.
Thanks a lot, Aman. Much appreciated. A lot of information. I think that was all. I would like to thank Joe and Dave for the presentation. And Randy, maybe we can kind of now open or turn over to panel, and probably it would be great if we could see everyone, kind of the speakers. And maybe I'm also happy to kind of share that we received questions, and which I'm gonna probably group into markets. I think let's start with markets. Question to you, Aman. I think someone asked, given the past few months, is tech still a good bet, or is the party over?
I don't think the party is over. I think the fiscal and monetary stimulus we talked about doesn't really have an end in sight. There's a very important U.S. election happening in November. There's a lot of political motivation to continue to provide a very favorable investor backdrop, and interest rates in the U.S. are close to 0% now, and that it seems like from the latest communications from the Fed, that's the intention to do that for the next 5 years. Europe is following a similar course. I think tech is expensive by traditional metrics, like I showed, but I think the opportunity now for real market share gains through digitization This is not a one and done situation. This is a 3 to 5 year story that's just accelerating what was already going on. So I continue to be very long and bullish tech, at least for the foreseeable future.
Excellent. Joe, how do you perceive Europe versus the US in terms of valuations, and where do you see the market to go in the coming 3 years?
Big question. I'll try to be quick. I see Europe as quite undervalued relative to US. Valuations, much lower generally if you compare like-to-like operating metrics. That's rising in Europe, although it's rising in the US. So as a sort of proportion, it's probably fairly steady, but more the later stage the companies get, the more developed they get, the more they become global companies. So there's this, I would say, early stage real dislocation, and as companies grow, they become more global in their customer base, their outlook, and so you do reach a point where capital flows, customer bases, and valuations are pretty similar in the kind of billion plus category. Next 3 years, I think it's a wonderful market. We kind of, it's, as I said in my comment, it's been a terrible year because we're in a pandemic and in the macro economy. I think things get probably worse before they get better. But for those of us in technology, we're providing a lot of the solutions that society needs. Everything from health to education and SaaS to me is a delivery mechanism. We have SaaS products within the education space, within the health space, within the financial services. And so that really cuts across all sectors. And, we kind of got a gift in a sense, it's maybe not the right way to describe it, but Corona has accelerated, as Aman was saying, adoption of digital basically in every sector.
I think, Aman, maybe back to you. You once mentioned, these kind of K-shape recovery. What do you see maybe in 21 if Corona, has a stronger impact on the traditional economy, as to also maybe public market developments? Will there, or to be more explicit, will there be more money flowing into the NASDAQ?
Yeah, I think the notion of a K-shaped recovery, people have been talking about V-shape versus U-shape, and how is the slope down fast and then a slow recovery back, or is it a quick bounce back? And I think that kind of misses a large point, which is for parts of the economy, it's happening very quickly. For other parts of the economy, they're going to stay depressed, I think, for a long time. And we've seen it at the sector level. Travel and hospitality and restaurants and sporting events are way down from where they were in February by 50, 60%, and are flat and not recovering very quickly. There's another segment that's up and to the right, and it's actually, as Joe said, doing better than they were back in February. So imagine kind of a K-shape where there's the winners and losers and haves and have-nots, and that's unfortunate, and that's a policy matter. But ultimately, I think for tech and the NASDAQ, they're definitely better than they were in February. The trajectory on spending and their market share versus the incumbents is clearly taking share. And a lot of companies like those retail brands I mentioned are putting digitization now front and center. This has been a wake-up call for a lot of them to continue to make those investments, which they were doing anyway, but this is accelerated. So I think the NASDAQ over the next 6 months continues to be on the path that it is because of these ongoing trends, which aren't going away anytime soon.
Makes perfectly sense. Maybe kind of asking you, Dave, I received a couple of questions, very specific, but before we dive into question on secondaries and what exactly you do, what's your view on market development, tech versus traditional economy?
Well, obviously, I'm an optimist, having been an entrepreneur and investor in Silicon Valley for the last 25, 30 years. You have to be an optimist out here. I generally think that Aman's observations are correct. We're seeing quite a bit of substantial growth across a number of sectors, as Joe mentioned. If you are skeptical, however, about whether these multiples are justifiable, the answer to that is really to buy growth. And so if you're looking at, hey, Zoom seems like a crazy overvalued company, Well, Zoom grew from 10 million users to 200 million users in Q1. Their revenue grew over 600% in the last year. So, if you think these companies are a little bit overvalued, hey, wait a year. They'll grow 100% or 200%, and those valuation multiples will get cut in half. So I think, the one caveat I would say to looking at these market multiples is you should really be making sure that these companies have sustainable margins and sustainable growth. And in some cases, that's a reason to step back into the private markets, where you can still buy these same sectors, but buy them when they're growing actually faster.
Question to you, very straightforward, Dave. After 500 Venture, you decided to, start in the secondary space. Why that? I mean, why didn't you just go long on tech and stay in primaries?
Well, I think, as I was just mentioning before, it takes a long time to run a venture fund. Just past month was the 10th anniversary of the first fund that I managed at 500 Startups. And that fund's doing quite well, over 7x gross, over 5x net. However, it took 10 years. I think, one of the opportunities that's great about the secondary market is you don't have to wait 10 to 15 years to see results. You can see, generated results really in a short period of 3 to 5 years. I think there's a question that's talking about, whether there's discounts on secondary markets that are justifiable, and, potentially given the hype in secondaries, are those discounts going to become smaller in the future and thus justifying smaller returns. That's true in certain secondary areas. So like we mentioned, private equity secondary has become a very competitive market. Companies like Collar Capital, Lexington, and others, deploying, very large funds, some funds that are $10 to $20 billion in size just by themselves. Those markets used to have significant arbitrage and significant discounts 10 years ago, 15 years ago. But these days, those markets trade secondary at close to par, and in some cases may trade above par. If we look at the company secondary market in venture capital, similarly, if you were beginning that, maybe 5 to 10 years ago, there were some very substantial opportunities to buy unicorn shares and equity at a discount, and that may still be true in a few cases. But again, we're seeing a very competitive market in secondary trading in unicorn companies. That's become a lot more competitive in just the past few years. And in some cases, we've actually seen, companies like Uber or Lyft priced higher in private markets than maybe where they end up in public markets. Probably again.
Apologies to interrupt. I think that's a key notion on what you described as you do fund secondaries. I'm not sure if everyone understood that correctly. So what is the benefits if you do fund secondaries versus company secondaries?
Well, again, on the company secondary side, there's a lot more transparency and visibility about what you're buying, and it's a single asset. There's also many online platforms. EquityZen is a company that we invested in at 500 many years back. Shares Post and Forge are another platform. Carta is another platform also. So there's a lot of participants, both on the sell side and the buy side, in company secondary. And as a result of that, the arbitrage is, somewhat less than it used to be. On the fund secondary side, that's not the case. There's fewer buyers for secondary. The process for evaluating fund secondary is a little bit more complicated. And just in general, it's harder to even be aware of what assets are for sale. So unless you're really in the market and know the LPs and GPs, you may not even be aware that these interests are for sale. It's definitely possible in the future. There is, more awareness and more competition for buying, and we might see some compression in those discounts in the future. But to be honest, we don't see that happening anytime soon, and probably at least for the next 3 to 5 years, there's some very significant opportunities in fund secondary that aren't there in company secondary and aren't there in private equity secondary.
Makes perfectly sense. Joe, just sharing your view out of Europe. How is the secondary fund market or venture secondary fund market developing in Europe? And what do you see for maybe 21 as to transaction volume? Will it go similar to what Dave is experiencing?
Well, yes and no. So the big picture secondary market, private equity secondary market, goes from strength to strength, continues to grow very strongly. Exactly as Dave said, I used to work for one of those firms. It's having year on year its best year ever. So that on the big picture is really a strong story. What I think is interesting, the way I would say a similar thing to Dave, but this supply demand dynamic plays out in segments where you have a lot of buyers and sellers. So the more buyers and sellers on a given transaction, the more it looks like a stock, shall we say, right? That there's a lot of puts and takes, and it finds a market price. Most venture capital doesn't trade that way. These are often direct negotiated transactions between the buyer and the seller. And there's not, I'm working on 2 right now where there's not even really a transaction. It's just approaching people we know would like to sell. So it's almost the opposite dynamic. And kind of what I love about it is this is how the private equity secondary market worked in the sort of early 2000s. Direct and negotiated private data. Nobody knew about these things. And that's still the case, particularly in early stage. The later stage you have more buyers and sellers, and then that other dynamic takes over. But we're in each of the situations, there are multiple unicorns. So it's not just that there aren't interesting assets there, but the small out of the way deals and off market, and everybody in private markets says proprietary deal flow. But this is an area where you really can have it, and you really can have market power and therefore a pricing advantage.
So Joe, to understand you correctly, what just to be successful in the venture secondary space, what are the qualities you need to bring to the table? Would you say you just need to be the network, or is there something else you should know about? Or maybe let me ask Dave. Dave, I think that's a question for you. I think probably better addressed. So what makes a secondary VC player successful?
Well, I guess there's probably a couple of different things. One is awareness of the assets for sale. Certainly you can't make money on an asset if you don't know there's an opportunity in the market to buy it. But even though you might know about it, you also need to understand how to evaluate it and whether it's overpriced or underpriced. As I mentioned before, it's more complicated with a multi-asset portfolio to figure that out. If you're just doing company secondary, particularly for pre-IPO unicorns, you might actually know what their revenue is. The company might even be reporting it prior to going public, but you're only investigating one company. When you're buying a fund, you're typically buying at least 2 or 3 or 4 positions that are large. You may also be buying a long tail of smaller assets that might make up 20 to 40% of the value of that fund. So it may matter a lot whether those, the primary assets that are the larger portion, are they overvalued or undervalued? Have they had a recent financing? What's the performance of the underlying companies? There's some fundamental analysis that goes on there, but also proprietary access to that info, which you probably wouldn't get unless you know the investors in the company or the founders of the company. And then you also have to look at, for that long tail of assets, well, they might be marked at a certain value on paper, but are they really going to get to an exit? Again, are they small and not material, or are they growing and possibly worth more in the future? So, these assets could be marked optimistically, but they could also be marked pessimistically in some cases. And that's where the buyer knowledge of the scenario really does make a difference. Are you buying at a discount because there's not very many buyers? Or are you buying at a discount because the asset's got something, impaired?
That's kind of the thing you better know of. Agreed. I have a very kind of broad question oh, please.
Mark, can I just add to that? Dave, I think you're selling perhaps it's your built-in advantage, so you're not selling it, but this idea of network, it's absolutely vital. And without that, so what you have is many, many years of establishing yourself as a strong market counterparty. And that, and particularly in these transactions, certainty of execution, certainty that the person across the table even has the analytical capability on these, quite odd transactions, that's a big deal. And so you can't just enter this market and put your flag out, I'm now a buyer. I think that's why I jump on it. You having those relationships and knowledge is key.
Yeah, thanks for the softball there, Joe. I appreciate that. I owe you a beer later. We started about 20 funds under the 500 Startups umbrella. We were investors in about 20 other VC funds, and we certainly invested alongside hundreds of other VC funds. So we do have a good bit of familiarity with these, smaller funds in the market. And I think really, something that's maybe not talked about a lot is what are the valuation policies of the VCs. The number that's being reported as the NAV is often self-reported. It may be audited, it may be not audited, but in general, there's not a lot of oversight in understanding, just because someone says a portfolio is worth 150 million, they might be optimistically valuing it based on, investments that were made a couple of years ago. There may be portfolio performance that's doing great, and actually it's worth more than 150 million, and it just hasn't been marked up yet. So it really does matter a lot. In a previous transaction we just did, we bought a portfolio where a company was marked at $1 billion. We fortunately bought that portfolio a few months before it was marked up to $3 billion in value. That tripled the value of that one company and increased the value of that portfolio 50% overnight. That was a very fortunate circumstance, but you don't want to be on the opposite side of that transaction where a company's valued at $1 billion and then next week it's out of business and you're left holding the bag.
Hey Dave, thanks a lot for these explanations. I think it's very helpful. We are coming timing-wise to the end, and I think there's one question I would like to ask all of you just to answer very briefly because we have 3 minutes left. If VC secondary is such a great investment, why haven't I heard about it? So, brief statement. Final statement.
I think I've been speaking a lot.
Let's start with Aman. Aman, what's your take?
Sure.
I think it's just it's a fairly new idea, so you may not have heard of it in VC. You almost certainly, though, have heard about it in private equity if you've been around that space. And by the way, like 99% of stock market transactions in the public markets are secondary. So it's not a new notion. It's just newly applied to VC. And I think over the next 5 or 10 years.
So we will hear more of it, you mean. Joe, what's your take on this?
Well, if you've invested in private equity secondary funds, you've probably heard about it. So they're all doing it. This isn't a kind of completely new area. What's new, I would argue, is the specialist. I believe the specialist can outcompete the generalist. There are very few, and I think there will be more. But yeah, that's probably, you're not seeing a lot of specialist firms out there. The ones who exist are doing very well.
Excellent.
As part of our work, not as the total thing. So yeah.
Dave, you have about 10 seconds left. I'm just going to take your final statement.
I think I'll point out one thing that's maybe not obvious about this market is, again, historically, you've had a lot of funds which are mostly backed by institutional participants, and they're not going to sell their winners, and if they don't have to, they're not going to sell, they'll hold on for longer periods. The thing that has really changed in the last 10, 15 years is the growth of the micro VC fund. These are funds smaller than $100 million. And the investors in those micro VC funds are not institutional. And not to say that all non-institutional investors are impatient or are going to sell, but there's a much greater capacity for these family office individuals and corporates to want to sell. And so these micro VC funds weren't around 10 years ago, and we wouldn't be buying their secondary positions until they're about 5 to 7 years old. So that phenomenon is fairly new, that those micro VC funds are mature and are available, and there's non-institutional LP positions that are for sale.
Dave, thanks a lot. I think let's close on these notes. Thank you all who listened in, much appreciated. Also, thank you to the speakers, Joe, Dave, and Aman. I think it was very interesting content provided, and next time we're going to plan more time for the discussion. For the participants, this webinar was recorded, and we will provide you the respective link, and you will have the opportunity to connect to the speakers and learn more about the current involvements. This webinar was brought to you by Investment Associates. Hope you find the session interesting and wish you all a great rest of the day. Thank you all.
This webinar is coming to a close.